It took 25 years, 8 months, and 13 days for the stock of which company to rebound from its dot-com highs?
Dong, 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 dong.
No. Cisco. Different Cisco.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome back to Skippy and Doogles Talk Investing. I want to remind all y'all that we have got a special promotion going on right now for premium subscriptions, skippydoogles.supercast.com. Go check those out. It's very helpful. You get the show early. You get some of our stop, drop, open up shop type recommendations.
Ooh, GMX. Good work.
Yeah, I know. R.I.P. R.I.P.
Yeah, that's right.
I got caught up in the middle there because a little tear came out my eye and I tasted salt. R.I.P.
I want people to remember that when we cover our first piece of listener mail here. I want to remember that.
Okay. All right.
You'll want a premium subscription after this.
You will want this. You will want this, people. We're going to start off with listener mail, a few different elements of listener mail. So we're going to go through those. Then we're going to discuss a Brookings Institute study based on 2023 2023 around affordability right now, which is all the rage, affordability as it should be. And then talk about private equity in college sports. Did I miss anything?
No, that's it.
Okay. Listener mail time.
Hit that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
I have to start with the first one. I'm sorry.
Okay. Do it.
We didn't cover this in the pre-show meeting. I don't care, Doogles. This is, I'm just going to quote this one. It says, "You guys called it." There we go. Are we done?
We're done. We're
It's
done.
applicable to every topic we cover on the show. This is why I said you wouldn't get your premium subscriptions. We're going to call it, even though we don't make predictions. Like, how do we do this? This is so great.
Yeah. And speaking of, before we get to what this specifically is about, speaking of you called it. So we had, Broadcom, my portfolio. Before earnings, they had earnings last week. Before earnings, I was talking to my wife, and I was like, I think we're going to end up Broadcom either 12% higher this year or 12% lower this year. Mm-hmm. I did not realize that either of those was going to come the immediate day after. Usually it's more of like a gradual, like people losing interest. But anyway.
It's a roller coaster. If we're going to go called it, the speculative name I talked about for our premium subscribers a few weeks back is up 20-some%.
That's right.
In the past couple of weeks. Like, it's craziness out there. Again, people, I hope you get the jokes or the sarcasm in our tone here. We're not predicting things, and we're not always going to be right. But I love a listener mail that says, "You guys called it." This is from Greg. The high-level story is Oracle's stock price is crashing, and people are concerned about their debt. And we just looked at some basic facts right after they signed that deal with the OpenAI. Looked at their debt levels. Like, this is not hard. It's so funny, though, that it took your average Oracle investor this long to come around to the basic facts.
It was so straightforward. So incredibly straightforward. Now, you never know how the market's going to react to straightforward things. I'm glad that this was even as short as it was for people to come around to, because you just never know. But it's pretty classically straightforward. I don't remember what episode that was, but it was back in September. Right? If y'all want to go take a look, you'll be able to see it in the title to figure out what episode we talked about. But thank you, Greg, for the call out.
Yes.
And that was the entire contents of his message. Exactly what you just said. You guys called it. So we appreciate that. Okay, next we're going to head on. This one will also be pretty quick. So the Treasury, United States Treasury, came out on the Twitters, all agloat. And they said, U.S. Treasuries are having their best year since 2020, and the investors who had confidence and faith in President Trump's economic policies have been richly rewarded. Never bet against POTUS or America. Okay, that is what they came out with. And they show this graph that's very politicized, but they show this graph where bonds way up in 2020, bonds way up in 2025, and everything in between is sad and red. That's what the graph looks like. If you go through the comments are basically like, you realize this isn't positive. It's all not all net positive. Like, do you understand what you're tweeting? That's what the comments say. But the listener mail, just to hit on that briefly, was this picture of Franklin the Turtle, kid's character, and it says Franklin the Turtle discovers that rising bond prices can also imply lower future growth expectations. And there's just a sad turtle with a graph. And I appreciate when people so quickly are able to create memes in this regard. That's really what stood out to me.
It's the best use of AI. I mean, just come on.
Yeah. It's just like, I think this was hand drawn. Okay? I believe this is hand drawn. All right. Third piece of listener mail?
Third piece of listener mail.
So this one, thank you, Adam, for this one. This one comes from a New York Times article, What I Learned When I Dug Into My Retirement Account. This was a late addition to the listener mail game, but it was interesting enough that we still brought it up. But what that means, given that it was a late addition, means we haven't been able to dive in incredibly deeply, but there's still some interesting nuggets to talk about here. So, worth raising.
Yeah, I mean, the gist of this is a U.S. retirement account that I'm honestly not too familiar with called the Thrift Savings Plan that manages $1 trillion worth of assets.
Yep. I know about this because my mom was in the State Department for a number of years.
Okay.
So her quote-unquote 401k was actually a TSP, a Thrift Savings Plan. So
helpful.
Yeah.
The TSP administration is not particularly forthcoming when it comes to telling you what investments they're making on your behalf, which is interesting.
Very interesting.
And it turns out if you dig deep, I mean, I'll cut straight to the chase here. There's investments in companies that partner with companies that are blacklisted by the U.S. So the author here kind of says, does this make any sense? I don't know. My take may surprise some people. When numbers get in the trillions, you have to put money to work somewhere. And I think if you dig deep enough, you can always find something that will upset someone. That's just kind of how I feel with this. Like, I'm sure you could go through the Chinese investment portfolios and they're somehow supporting America and someone doesn't like that. And I'm sure you could go through the European portfolios and they're somehow supporting the Middle East. And I think capitalism isn't always nice and clean. So I'm not too fired up about this. Could it be improved? Sure. But do you disagree with me, Doogles?
I don't disagree with you. I think going back to something that you stated when you mentioned this at the beginning, what was most interesting to me here was the fact that this man had to had to file a FOIA request. So that's a Freedom of Information Act request to figure out what was inside of his account. That was the part that really stuck out to me. To the rest of it, yeah, I don't disagree with you. I agree with that point. I mean, it's kind of, you've said this a few times in the pod, it's kind of like if someone says, I refuse to own Tesla stock because I don't believe in Elon Musk, blah, blah, blah. You do something like that. Or I hate oil, and so I'll never own Exxon. But I'm going to own SPY, which is an ETF that does own Exxon and Tesla. It just, you kind of, if you're going to be in the investing game, in the passive investing game, which is what we recommend for most people, you're just going to own stuff. Like, it's just going to be the case. I think that if this was true and he didn't have to file the information request, it would be a little bit different. I think the reason why it probably even stood out to Jonathan Hillman was because he's like, you hid it. And then when I looked at what was hidden, it's questionable. Yeah, but if it were just there.
It feels shady to start. And then I'm going to go through it with a more keen eye.
Yeah.
I'm looking at why. Why won't you just tell me where my money is?
Yeah.
There's a huge problem with that. And I would hope that gets fixed, to be honest. What investment, if this was a non-government entity, if this is Fidelity or Vanguard or whatever, and you go, tell me where my money is invested, that's available in like 7 seconds.
Yeah. Or should be. If you can't find that, then that's problematic. Yeah,
7 minutes max. It's easy to get.
It's kind of like I come home, let's say I come home at 9 p.m. some night, 10 p.m., whatever. A little later than I should be coming home. And my wife's like, where were you? And I was like, don't worry about it. Then she'd go, wait, no, like, where were you? And I was like, I was just at a bar. Which bar? Don't worry about it. Well, okay, all right, I was at XYZ bar. Who are you with? Don't worry about it, right? And it's like the more that I say that, the more it turns out that if I was just hanging out with Skippy, I should have just said that in the beginning. Because this would have mattered.
I mean, don't worry about it. Could be a good name for a bar, to be honest.
It is. You know what? The terrible name is Bar. And I've experienced that. And like you ask someone to meet you there and they can't even Google Maps it. It's a whole thing. Anyway.
We used to go to a spot in Europe that was the bar with no name, and telling all your friends how to get to the bar with no name, with no sign, it was a whole ordeal.
Yeah.
Like you had to walk through another bar to get to the hidden staircase to, pros and cons. I'm going to throw one more thing in the listener mail section.
Okay.
Let's just call it listener mail from me. It took 25 years, 8 months, and 13 days for the stock of which company to rebound from its .com highs?
Thong, 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 thong.
No. Cisco. Different Cisco.
Okay.
Right?
Okay.
But same time frame. There we go.
Yeah, that is true. That is true. I saw this past week that Bank of America stock finally hit its pre-Great Financial Crisis high as well. So there's
crazy.
And again, we don't know, don't predict, we don't know what's going to happen, but some things are so frothy right now that treasure this, Cisco. Treasure it while you have it, because you never know what's about to occur next. It would suck so bad though if they hit that and then.
I thought they were going to get within $1 and then things were going to blow up. So at least they climbed the new mountaintop. For those who don't know, Cisco was one of the classic names in the year 2000. Their high was actually March 27th of 2000 when it briefly surpassed Microsoft to become the world's most valuable company. Okay.
Yep.
And that was at basically $80.06 per share. It just reached $80.25. 25 years, Doogles. If you buy something at the time at its previous peak is at 100 PE, right? So it's pretty consistently grown earnings over the past 25 years, but it doesn't trade at 100 PE anymore. This is when people talk about lost decades, what they mean. And this is part of investing. This is why I am always concerned about buying things when the valuation is crazy.
So pricey. I mean, that PE is out of control back then. We have some that are out of control now too, but the control back then. You know what I didn't look up this week, but I'm saying this out loud just to remind myself. Are there any companies, because I was looking at Oklo this week, they had earnings. We've talked about them before. They don't have any revenue. Are there any companies ever without revenue that have had sustained stock price appreciation? I don't know.
This seems so obvious to me it doesn't even seem like researching, but tell me if I'm missing. Ultimately, long term, companies perform as their free cash flow performs, or at very least earnings. You could argue maybe you spend that for reinvestment, kind of like Amazon did in the early years, but Amazon also had a 97% drawdown in the early years with its stock price. So in order to get earnings, the one thing you definitely need is revenue.
You have to have revenue.
In order to get free cash flow, the one thing you definitely need is earnings. So how?
Yes, but that becomes a little more accounting tricky. You're right, but you have to have revenue.
Term.
You have
I'm
to.
talking
Yes,
long
yes,
term.
that is true. That is true. That is true.
Anyway, so what's your base case for a zero revenue company continuing to have price appreciation long term? How is that even?
I don't know, but
possible?
I'm just wondering if it's ever happened. That's all I want to know. Because I'm having more. This isn't just about that, but I'm having more and more of these conversations over the last, I'd call it probably 8 weeks, with people. It's this time is different. That's the general theme from folks, and I just have these convos, and I'm like, okay, great. Just so you know, that's never happened before. That doesn't mean that you're wrong. Or I'll say the opposite, and I'll be like, okay, well, every other time this has occurred, this is what has happened after. That doesn't mean it's about to occur. But when you look at 100% scenarios, it's worth taking a little bit of a pause. So I was just curious looking here. I mean, Oklo's up 9x over the last, 18 months or something. It's something, I don't know, whatever, something like that. And 5x in the last year or something. It's that's sizable appreciation. If you've owned it during that period, great. You know what I mean? Have you seen the movie Get Out? I don't know. Just throwing that out there. But I'm curious if any company's ever done it. So I was just throwing that out as an aside. All right, Fishbowl.
If you own anything like that, especially if it's a zero revenue company, one, you're not investing, you're speculating. But two, take your initial capital off the table. All right, just do it. If it's up 8x, your initial capital is nothing. Take it off the table,
Take
and then
more
it's
than-
free from there.
take more
I'm
than
saying
your
at
initial
minimum.
capital.
Yes.
Yeah,
I would take all of my capital off the table because I would regret the initial purchase I made.
I would
But
actually
that's
return
just
it. I'd write a check to the company and just be like, I shouldn't.
I
Have
don't deserve this.
Okay. All right. Let's reach into the fishbowl. I'm going to go to this Brookings piece. Brookings Institute, think tank, folks I'm pretty sure probably heard of it. They came out with something in the last couple weeks, report. In every corner of the country, the middle class struggles with affordability. As I mentioned in the intro, affordability is just, it's the headline everywhere. It's been the headline for, 2 years? 3 years or so now?
No, probably since 2020, to be honest.
Yeah,
I
it could
mean,
be.
at least right post-COVID. People had some money from the government checks right after COVID, but
So, what's unfortunate here, but this is the way that research works. What's unfortunate is that their research ends in 2023 because it just takes so long for them to compile this stuff. But just take it for what it is. Still find it to be interesting. So one, as they mentioned in the headline, it's everywhere. This affordability issue is everywhere. It's not limited to, as they mentioned, a few pricey cities, which sometimes people can imagine that that's the case. And they looked at the middle class specifically, which they define as that middle 60% in the income distribution. That's what they call middle class here. So they cut out the top 20%, cut out the bottom 20%. I think that's fairly standard. What that income is between $30,000 and $153,000 a year. So effectively, it's the two poverty lines that we discussed before. You take two.
that's a
poverty
wide
lines.
range, man.
It's a
A few
wide
weeks back, you were fired up at about a range between like 50 and 80, and now we're talking 30 to 50, 30 to 150. Like, come on,
30 to 153. Like, just put a
Yeah.
little more nugget. All right, so that's the income distribution. The middle 60% here. They analyzed 160 metro areas, and they found none where 100% of the middle class can afford basic living costs.
Well, but again,
Okay.
I'm done after this. But if your low end is 30K, yeah, of course you can't afford.
Okay, just throwing that out there. In relatively affordable places, at least 20% of the middle class can't make ends meet. 1/3 of middle class families nationwide can't afford basic necessities. Again, this is as of 2023. And despite being in the quote unquote middle class, again, that's a really wide range. I get that. Then they looked at it for race as well. And this is basically showing that it's widespread but uneven. Not surprising if you take that range out. The white middle class is about 27% of people they said will struggle to afford basics. 39% of black middle class, 41% of Asian American, 46% of Native American, 50% of Latino, Hispanic families. So it's, again, widespread, uneven. Some metro areas, they mentioned D.C., Minneapolis, Dayton, Pittsburgh, have a higher share of middle class affordability. So that's good, but it's still at least 20% of people struggle. What's important here is because, and I think that while this is a heady think tank, elitist, whatever you want to call it, type research report, and I'm going to get into the types of jobs they have because I think that's an interesting one in a second here. But
Yeah.
even though it's all those things, the affordability conversation that's been disconnected, I think, and it's disconnected right now in this administration as well. But it was what was disconnected in the Biden administration. It's disconnected right here between government and the peeps. As you look at the aggregated data, and it's like, things look good. Everything looks good aggregated. These people don't know what they're talking about. You don't know your own life. And I think that this article basically says like that this is at least, it's an aggregated version of what life on at the ground level could look like. It's like people are struggling. It's some kind of a bridge, but it's still heady and elitist. So I found it to be helpful for that particular reason.
Yeah, I mean, the really shocking stat that's come out within the past 3 months goes something like this. 50% of discretionary spending in this country is driven by 10% of the population. So
Yeah.
the headline numbers continue to look pretty solid. But I think the argument behind the scenes is, yeah, but that's just happening with the people that own equities and were already super rich. And they're not going to sweat anytime soon.
They might, actually.
Well, depending on what their investments look like.
Exactly.
Not with my portfolio, but with the Oklos, sure.
Yeah. I'm going to learn that you're 50% Oklo and you're just hiding it. No, But to your point, I mean, this is so long as the stock market stays up or relatively up, there's a group of folks that will not sweat.
Mm-hmm.
And either because their finances are actually good or because they feel like their finances are good because their stock portfolio is good. Either
It's
one
probably
of those
number
scenarios.
two, to be honest.
Yeah.
It's number two is more powerful than people give it credit for. So back to this Brookings Institute piece. This table that breaks down the type of individuals by race, by occupation. I keep trying to make like a headline conclusion here because I want to think that if you have the right job, you might be protected from this in the middle class. But I don't know that I see clear guidance here. Is there anything like that question is kind of interesting to me, but I'm not sure that they answered it. Do you feel like they did?
Not really. No, I think what they're trying to say here is that first sentence that's in the second paragraph in that section where it says many blue collar jobs are still a part of the middle class. I think that's kind of what they're trying to say is if you look at the middle class, these are the jobs that the middle class has. And there are, for example, 15% of Native Hawaiian or Pacific Islander folks that are in transportation and material moving. Like, that's middle class.
Yeah.
And it's probably not what, when the concept of middle class pops up, that may not be what people think of. I think that's all that they're trying to demonstrate there. Otherwise, there's just really some industries that different races are much more concentrated in.
Yes, which is fascinating, but probably not surprising. I think my frustration goes back to how wide the range is because the difference between someone making $31,000 and their typical occupation versus someone making $50,000 and their typical occupation, to throw that all together feels like it's just too broad.
Yeah, it's kind of, and I haven't seen this, but I think it'd be kind of interesting if there was someone that did a study like this, but looked at at least six figures, but maybe under 150, like look at the 100 to 150, because then you can say, this is what six figures in the U.S. right now gives you, which is it's a somewhat arbitrary number, but the idea of six figures, historically, at least I can think of what six figures represented when I was growing up. Like that's a different, you're there. So that'd be interesting. But yet and still, skippydoogles.substack.com. We'll put this on next week. You can go take a look through the Brookings Institute piece. Was there anything else that you wanted to cover
it's an interesting piece. I always really want like a strong conclusion or insight, and there's just a lot of good data here. I don't know that it solves anything, but it's a tough problem to solve.
Mm-hmm. Okay, last item in the fishbowl. The U.
Well, the U and other things. That
might be the title of this episode. The U and other things.
I could talk about this sort of stuff. I almost got a master's degree in sports business. I obviously love investing. I obviously love sports. I could talk about this forever. I'm not. I'm going to really simplify things because I think your average person does not care at all about this. But private equity is officially landed in college sports, and it appears there's a tidal wave of private equity coming. So I think I'm going to set a little background of why your average college athletic department feels poor. Then we're going to talk briefly about the University of Utah.
Okay.
Then we'll talk briefly about the Big 12, who happens to be the conference that the University of Utah plays in. And then I have one question that's going to break your brain.
Ooh, I love it. And that's coming at the end.
At the very end.
My gosh.
All right. So in the 80s and 90s, college sports started signing multi-million-dollar contracts with television providers. In the early 2000s and more like the late 2000s, those became billion-dollar contracts.
Oh, yeah.
And going back to really like the 40s and 50s, and it's more the 50s, there was some talk that college athletes might deserve compensation.
Okay.
The NCAA fought this like it was the world's biggest injustice until about 3 years ago, when they lost this landmark lawsuit that says you're obviously taking advantage of these people when you're signing billion-dollar TV deals. That is to watch these athletes play, and so you have to pay them. That settlement was a mess, and basically what came out of it is there's back pay for athletes for the last 10 years that never received compensation, and going forward, there's some sort of quasi, it's almost like a salary cap, but it's different because the landscape's such a mess, where major athletic departments, Power 4 conferences, which would be the SEC, the Big Ten, the ACC, and the Big 12, can pay their student athletes, all of their student athletes, $20.5 million per year. For those who don't follow college sports, you also might have a football coaching. Go ahead.
Is that per school?
Per school, per year. For those who don't follow college sporting events, big state university might also pay their football coach somewhere between $5 and $10 million a year. Might pay their assistant football coaches somewhere between $5 and $10 million a year in aggregate. Might pay their basketball coach somewhere between $2 to $10 million a year, et cetera, et cetera. On top of all that, you have Title IX, which says sporting scholarships must be distributed equally. In most cases, the large majority of that $20.5 million goes to football and basketball teams. But there is some thought that Title IX might eventually rule that the way that compensation is distributed has to be distributed equally between the athletes, which is a very interesting wrinkle. All this to be said, your average athletic director has somewhere between a $20 and $30 million, $20 to $30 million in excess expenditures because of the back pay from the lawsuit, the $20 million going forward, et cetera. Coaching salaries that are rising like crazy.
Beyond just running the team.
And these budgets are easily in the hundreds of millions of dollars. The top end's more like $200 million. A mid-tier Power 4 university will be $70 to $120 million. It's a huge deal, right? But say you're running a $100 million athletic department, and all of a sudden it was $100 million next year, and in 2026 it's going to be $130 million. You have limited sources of revenue. A lot of revenue comes from TV deals, and then the large majority comes from ticket sales. I'm intimately familiar with this because I'm a season ticket holder for one of these universities, and the university that I'm a season ticket holder for doesn't even matter, although the listeners probably know. Last year, in 2024, had the highest per ticket price of any place in the nation. There was that much demand for their tickets, right?
Yeah.
So where does this ultimately end up? It ends up in the fans of the teams paying more money. That's the only way this equation works. But what has happened is we've brought our friends, and Skippy and Doogles truly love our private equity friends. Truly love our private equity funds. We have invited our private equity friends. We'll just call them a fox. It's just for this analogy. Into the hen house, right? The University of Utah is the first group to do this, and they partnered with a group called Otro Capital out of New York City that's run by a few former sports execs. I think one of the main guys used to work for the Cleveland Browns, et cetera, et cetera. I'll pause for a second before I dive specifically into this deal. Is there any of the high-level background stuff that I missed, Doogles? Or any more questions that you have?
No, let's roll in.
Okay. So the deals are unclear, but to make things more complicated, universities are nonprofit tax-exempt entities. They've created a spin-off LLC that the specifics aren't super important, that will be a for-profit entity that is shared between the university and this private equity group. There's already some buzz with senators that this could be illegal and that people are willing to sue or litigate or whatever. So that will be fascinating. But effectively, Otro Capital came in and said they're going to give a 9-figure capital infusion. It could be as much as $500 million, but I don't think anyone actually knows the numbers. For a future revenue share of that for-profit entity. Again, no one is publicly sharing what percentage of future revenue the private equity company will get, but I have heard speculation from the person that wrote the article, who's pretty well in the know, that could be as high as 45% of future revenues.
Wow. Really?
Yes.
Wow.
And like, just think of this as a startup or a business or whatever. Anyone that buys equity in a startup does some sort of financial plan that says, I think this is what's happening in terms of future revenues, and I want this ownership in the company or this percentage of revenue. I mean, OpenAI has done this 1,000 times in the past. Obviously, all those specifics really matter. If they get 1% of future revenues for $500 million, I'd say this is a great deal. If they get 45% of future revenues for $100 million, I'd say this is a horrible deal for the University of Utah. We don't know those specifics, and I won't even speculate on those specifics. What's your reaction to this, Doogles?
So one thing I'm curious about is I'm looking through. Did you look through the deck that University of Utah had for their Board of Trustee meeting?
No.
So I don't know if I'll go this far, but they also have, you can watch the meeting online. I didn't go that far yet. We'll see if I do. But there's a deck from the meeting that's in here. And so they state what they're trying to solve for, and they state what they thought about, like the options they evaluated. The options were do nothing and risk widening the gap between revenue and expenses, raise student fees, cut research programs, or cut some or all athletic programs. Okay, I get that. So I decided we're not doing those things. We need to be innovative and find new money. In fact, we must be innovative to create new sources of funding and generate more revenue for Utah athletics and the university's mission. That's what they said.
Wait, quick time out. New sources of funding for the University of Utah. That comes from the fans. That is my entire one of my entire points is like there's only certain people that care about the university athletics program. So if you need more money from them, you're going to extract more money from them. And whether private equity comes in with operational expertise or not, like it all just means take more money from your fans. And you better hope your fans put up with that and stick around.
What I'm curious about is what were the other sources? It's helpful to know the other options, the options they evaluated. What I want to know is what other sources of funding they evaluate. Like, how did you land on private equity? Who rejected you, and or what did you think about it? Honestly, but aren't you curious? I'm really curious. And because this is, if it was generic school, I wouldn't say this. But because this is University of Utah, what did the Mormon Church say? Like the Mormon Church has so much money.
Okay,
and they care deeply about the university.
We're quickly out of my area of expertise, but I think the Mormon Church cares more about BYU, although they probably care about both, but certainly more about BYU. And BYU's coach was almost hired at Penn State until it seems like the Mormon Church and some other parties stepped in, potentially with some funding. Yes, that's an interesting thing, but I don't know. That feels like a lot of speculation to me. You're willing to make that direct tie?
No, I was asking there's an entity that exists inside of your state that you have deep ties to that has a lot of money.
A lot of money.
How did you end up in private equity? Like that's the question. It's like where Bill Gates' son is taking out like a payday loan from
a loan from
somewhere.
Bank of America.
Yeah.
I mean,
like, how did you end up here? Your dad said no?
I don't think it's that direct. I would, if it was BYU, I would feel like I'd have more of those questions. I think this is the state university, and they have to do the separation of church and state thing, and I think it's
literally in this case. Yeah.
I was trying to hold this, but I'm just gonna get there because I need your thoughts on this. The question that no one else seems to be asking that is driving me mad.
Yeah.
What is so unique about a university, especially these big state universities that have been around for 100 plus years, is they have an endowment, and they often have an endowment that's very large, certainly much larger than $500 million. And I understand that money is typically tied up, and it's not like you can write a $500 million check tomorrow. But if this is such a good investment, right, for the private equity folks or for the university, why don't you take some money from your own endowment and do the private equity deal? This is the only entity I can think of in the world, basically, that says we need a cash infusion, and we have this huge arm that is part of our same group that could give us a cash infusion because of the changing landscape of college sports. People act like no one has even mentioned that. It seems like such an obvious fit if the numbers actually work. And the reason I think no one's mentioned that is because the numbers actually don't work, which means this is a terrible deal for the University of Utah.
So I'm going to tie this in with my last thing, just because I just want to throw the point in again, but then we can get right off of it. So University of Utah endowment is approximately $1.65 billion. This is as of last year. So, but let's just take that roughly, $1.65 billion. Mormon Church is about $290 billion. So I'm just going to put those two. That's it. I'm just going to throw it out. Just going to throw it out. Like $1 billion could fall off the truck and like it wouldn't even matter.
They're like, oops, that was our Oklo stock. I mean,
yeah, exactly. That was. Sorry, we can't get in because Oklo YOLO. But it's a great question. I think you raising that is a great question. It kind of gets back to, if you ignore the church for a moment, my high level question was, what were the other sources of funding that you tried that didn't work?
just talk to me about that a little more, because I think, well, one, there's not many people that have 100 to 500 million. I mean,
there's actually a lot.
Well, yes and no, like in terms of pensions and other things, but it's not like that. It's not like there's a ton in Salt Lake City available.
But where does 500 million come from?
It's speculated. The reporting clarifies that the infusion is 9 figures. That's where it get the 100 million, and could be as much as 500 million.
Okay, sorry. That sounds like a lot. Like,
oh, actually, hold on.
I don't know why would they need that much.
Maybe the wording there is is expected to generate as much revenue as.
Okay, that makes more sense, because the Utah is responsible for $1 million per year for the next 10 years, something like that. It's like not a.
Yeah. The point. Sorry, that's a good clarification. The point is, they won't tell us what the cash infusion is.
No, they won't.
That drives me crazy. They also won't tell us what the percent, I'm going to call it a revenue share for simplicity, like what the percent equity is. The other thing that could happen here is, apparently, I've heard this speculated, but I don't think anyone knows. Apparently, the private equity group can turn around and sell their portion within 5 to 7 years. So even if you have like a great partner today, which I'd argue you probably don't, but if you do, there's no guarantee that you'll have a great partner 7 years from now.
Yeah, that's very true. What I'm about to say is super dumb, but I still want to say it with you. How's your Spanish these days?
Excellent.
Okay. So if Utah walks in, right, you're chair of the board of trustees, you walk in, you're like, man, we got this private equity deal. You go, oof, I don't know how you landed with private equity, but, I trust you. So you got that KKR? No, otro. Oh, so you got that Blackstone? No, otro. Okay, that's fine. If you got TPG, I can understand. No, sir. This is who's on first type situation. We landed with literally the last private equity firm we could have. And it just happens to be called
they specialize in
I know, I'm joking.
and blah, blah, blah. But
brand
I just really don't get it. The equation works. The money has to come from their fans.
Ultimately.
So I think I would prefer, but listen, I'm weird. I like businesses that make money. Like, I like profitable businesses. That's just how so if they came to their fan base and said, dynamics has changed, this is terrible, football and basketball ticket prices are increasing by 50% this year, would there be a revolt and a rebellion? And but would they actually own 100% of the revenue that comes in the door? Yes.
Yep. Yeah.
And then they'd find out very quickly if they need to make significant changes to their P&L, because that would mean they can't pay their coach $10 million a year anymore. I just prefer to get to that truth as soon as possible.
Fully agree. And you could also, to me, this is related to, I was just looking up the richest alumni from University of Utah. It seems like number one from my quick search is Bill Gore of Gore-Tex, worth about $800 million. It also doesn't seem wild to be like, could we get a little, again, we don't know how much is coming in, so it's hard to like fully say. Like a $10 million gift doesn't seem kind of wild.
Okay. Yeah, I mean, you're going to derail this, and we need to get back to one other question. I mean, Michigan State University just took in a $400 million gift.
Yeah.
Texas Tech University has their richest donor is worth $13 billion of oil money, and he is self-funding basically a $50 million football roster every year. We know about Phil Knight in the University of Oregon. I mean, it seems like what lawsuits and dynamics are leading to with football and basketball is how rich is the richest alumni and how much do they care about your athletics? That's a whole different thing.
Yep.
But it's rather disappointing. I need to loop back.
Okay.
You keep saying, like, who else did they talk to? I guess I'm dumb. Where else? What else? I mean, sure, alumni is a great place to talk to. I would hope they'd talk to those folks. And this deal is unique that if huge alumni wanted to write like a $5 million check, they could get some of this equity. I do like that structure of it. So maybe they went to their alumni, right? They did their projections. They said we need $100 million. They went to their alumni. They got $20 million, and then they took the other $80 million. What's so crazy is college sports. Well, colleges have been doing that for hundreds of years, and in the past, it was write us a check for $400 million and get no profit stream off of that. I don't know why you'd be eager to change that approach if you're the university.
And the reason I keep bringing it up is because of what you joked about at the beginning of this segment. I have such a distaste for private equity. Like, to get there to me is you must have tried everything. And that's not where everyone sits. And that's probably not where everyone should sit. But that's why it keeps coming up for me. Like, if I ended up on the private equity gravy train, desperate times call for desperate measures, and I've gone everywhere. I'm not saying that that's where they sit.
So that's a very fair perspective, and I have similar beliefs, but there just seems to be a lack of willingness to accept the realities of their P&L. And what I mean by that is their revenue comes from ticket sales and TV money.
I know, yes.
We all feel like paying $90 a month for YouTube TV is already a little crazy.
Yeah.
You know, like cable television has been dying for 5+ years.
$70 last month, though, on that YouTube TV because of that Disney rebate.
Because of a debate about sports content with ESPN.
Exactly.
Like, this is my point. So there aren't many, like, you are wringing those revenue streams dry with television money, which I can't imagine continues to expand exponentially forever, and ticket sales. And so right size it. Like, not everyone has to compete with Ohio State University or the University of Texas that has a $250-ish million budget.
That's right.
Like, the University of Utah is not that. That's okay in my eyes. Maybe that's not okay for them.
I think it's a great take.
I'm winded. I'm exhausted.
Go catch your breath.
Perfect. We hope to see you guys next week. And listener mail, skippydoogle@gmail.com. Premium subscriptions, skippydoogle.supercast.com. That our current sale goes through the end of the year. So if you want to support the show, grab that here shortly.
Get in there. Thank you, everybody.
Thanks, guys.